And we're now live. Welcome, everyone. This is John Hutchinson with Traders Reserve's Traders Reserve special presentation today. And before we get started, I just want to make sure that everybody can hear everything okay. So if you would, just type a yes or a Y in the question chat box to the right of your screen there. This presentation is being recorded. The audio does take about 30 seconds to reach you. So just bear with that. You will be able to keep up just fine as we get underway here today. I have a very special guest. I was going to work with you folks on options trading. So whether you're experienced or an inexperienced trader, you're going to learn some very cool tricks today. So make sure you take notes. We'll stick around to answer as many questions as you need answered. And you'll also get an email a little bit later today with a replay of this webinar. Just checking on a couple of the messages there. So we're off and running. You will get a replay of this webinar a little bit later today after we have concluded this. So it is being recorded, and you'll have plenty of time to go back through and watch the replay. So it looks like everybody's hearing us okay. Sorry for the minute delay there. I was practicing my introduction, so I wanted to make sure we had that right on. So let's get underway. My guest today is Ron Haight, COO of Market Tamer. Ron is a stock and options trader, so you're going to be learning today from someone who practices what he preaches. And he's taught tens of thousands of traders really from all over the world, and he's very passionate about helping other retail traders protect and grow their stock portfolios through the application of options instruments. Now, option trading can often sound complicated. What I think you're going to find is Ron keeps it simple, and he teaches you how to use proper risk management and improve your overall results. So make sure that you take good notes while Ron is doing his presentation today, and make sure that you ask questions, because he will stick around to answer, as many questions as you want or as you need answered through the end of this presentation. So Ron, I want to turn the presentation over to you so we can get started, and thank you for joining us today. It's great to have another options expert out here helping self-directed traders.
Hey John, thanks so much. I really appreciate you inviting me in for your folks. It's great to be here. I just want to make sure my volume's coming through good, and so if you can let John know, everybody just type in a yes or something just to make sure you guys can hear me and see me okay. It sounds like everything is up and running. So again, it is really great to be here. As John gave me a very kind introduction, I am the COO of Market Tamer, and I'm a trader. And what my goal here today is to talk about how we can hedge some risk, but we can also make money using options. So what I want to do is definitely keep it simple. I'm not going to delve into the Greeks and the Vega and the gamma risk and all kinds of maybe cool things that you might want to know if you're more advanced. But I want to keep it simple, because when I first started trading options, I would pick up all these different books and by prominent people, and it always seemed that it was always made a little more difficult than what it needed to be. And in fact, I almost gave up at one point. I'm thinking, man, this just seems too complicated. So I do want to talk about making $1,000 trading options. I do want to talk about hedging risk, and I want to talk about how we can repeat it. So it'll be a little interactive, it'll be a little fun. So let's just go ahead and keep moving. I do want to keep you guys under an hour, so my goal is to be through this in about 45 minutes to respect your time. I do have to show the disclaimer. And everything in this presentation is for educational purposes only, and is not advice or recommendation to buy or sell anything. Now that's for the legal authorities and also the NSA, who probably should not be listening, so we can all wave to them. So I've already done the intro, and so has John. It's really nice to be here, and I really appreciate your guys' time. So let's sort of have some fun here. Now, we told you guys that this presentation is going to be about making your first 1,000, right? But actually, that's not what it's going to necessarily be about. Making your first $1,000 by having a process that is repeatable, so you can make not just $1,000, but 2,000, 3,000, 5,000, 10,000 and more. That's what the presentation about. So we're not just going to start with 1,000. We want to be able to keep doing this over and over again to generate that income. And we're going to take it a step further, because sometimes more important than making your first 1,000 is definitely protecting your portfolio. That may be thousands or tens of thousands or hundreds of thousands of dollars. I mean, today in the market's a great example. We go down hard 2 days ago. Yesterday we have one of the biggest rallies in a long time, and as of right now the market is tanking again. We can't let fear creep into our trading. We have to be protected, and we have to be able to sleep at night. And as a bonus, I'm going to show you how to make Seriously, thousands of dollars, even when the trade that you place goes completely against you. So by the end of this special session, you should know not only how to make your first $1,000 trading options, but also be able to make way more than that, even if you do exactly the wrong thing when you start the trade. Now, it may seem impossible, but you're about to see one of the most powerful option trading techniques out there. So let's get straight to it. Most nest eggs are comprised of what? Assets, right? Or what people think of assets. Now, the home, a stock portfolio, fine art, hey, even the gold Krugerrands, they can be assets. But you know what? What you really care about aren't the assets. You care about the income. Because without income from assets, you must continually sell those assets to provide the income. This is definitely not sustainable, and it's going to deplete the asset base eventually. So to maintain a standard of living, we have to make those assets create income, whether it's property via rent, whether you're buying an investment property and then just going to sell it. You know, sure, if property appreciates, it's a bonus, but we need that income, and rent's a great way to think about it. And the same exists in the stock market. Free money. I know that sounds weird, right? Really, free money? It seriously is. There is, quote, free money for you every month in the market. So let's start by figuring out how to produce that first 1,000 on a stock we already own. And this is going to be really, really simple. So the first question to ask is, over what time frame could you make your first $1,000 trading options? Now you want to start with a time frame that uncovers your risk tolerance and reward preference. This is crucial. If you have $50,000 and you want to make $5,000 per month, I'm going to ask you to stop right there, because $5,000 per month on a $50,000 portfolio, yeah, we can do that math. It's 10% a month. Holy cow, that's 120% a year. Warren Buffett only shoots for 10% a year. So sure, it's possible to make 10% a month, but is it possible to do that every month? Well, with your stock portfolio, you could be making a couple thousand, 3,000, 5,000 each month. But what if you have a small number of shares? 500. So why don't we start with something smaller? I know lots of traders out there, and we talk to our members, and they're like, hey, I have 10,000 shares of so-and-so. But not everybody can do that. Maybe you just have 500 shares, and you should be able to do income on that. You could even do income on 100 shares. So we're going to cover strategies, that can produce the income in a moment. But please always remember this golden rule. Always analyze the big picture first, because most stocks are going to move with the market. In fact, over 80%. We just don't want to apply any income-producing strategy blindly, because there are times when the strategy we're going to talk about today may be pure awesome, and then maybe if the market goes into a bigger correction, we have to not only use that income-generating strategy, but we may have to add some other things to it. So there is no one perfect strategy for every trend. We have to be willing to go with the trend. So if the major market trend is bullish, what are we going to do? And overall, if you go to a weekly chart or a monthly chart, the market's still bullish. Now, right now, we're having a little bit of trouble, so we might get, a little downward pressure yet. But the trend line or the trend going back weeks and months is still very, very bullish. So if we pick a stock in a bullish sector and it's still moving higher, maybe it's a Facebook, maybe it's a Twitter, maybe it's a Dominion, whoever that might be. So I want to start there. Even Apple was hanging on. If the technical trend is bullish and the moving averages are pointing higher, guess what? Your stock is going up. So you might say, well, how do we get past step one? Find a stock. You can use some very normal everyday moving averages. Put a 5-day EMA, a 20-day EMA. Put a 50-day SMA, a 200-day SMA. Those are simple moving averages, an exponential that we use at Market Tamer. If you guys like an 8-day or a 13-day or a 22-day, knock yourself out. It's awesome. But if all your moving averages are pointing higher, it already tells you what the trend is. The trend is up. What's the next thing we're going to do? Well, that's step 2. If you have these stocks in your portfolio, and I hope they're optionable, which most stocks are, What we're going to do is we're going to use the options market to our advantage. And we're going to sell what's called a near the money call option. If you talk to professional option traders out there and you ask them what's the number one way you consistently make your money, they're going to talk about selling premium. They're going to talk about selling options. And that's exactly what we want to do. That is, quote, the free money that's laying around out there. Now, some people, as soon as they see step 2, they're like, wait a minute, I know what that means. That means if I sell a call against my stock, I may have to sell my stock. Like, hold your horses. For today's presentation, I want to keep it simple. But even if we add a short call option against our stock position, and that stock still goes up, oh my goodness, there's so many other things we can do. We could adjust the short call. We could add additional long calls. There's a lot of cool things we can do and still profit from a continued uptrend. So don't let that thought, if you're already an options trader and you see this, it's not a negative. It's just the opposite. It's a huge positive to sell calls against your stock. Now, when we do sell calls against our stock, it's typically done in a 1-to-1 ratio. So for every 100 shares of stock, you typically will sell one short call. Typically, they're all done at the same strike. Typically, they're all going to be done in the same expiration cycle. Now, I know some of you guys out there are more advanced, and you might be thinking, but we could stagger those. Yeah, I'm going to say hold your horses again. I want to keep it simple. You bet there's a lot of cool things we can do out there. So we're going to focus on one short call option for 100 shares. That's going to be called a covered call strategy. Long stock, your 100 shares, one short call. Now, in today's example, we've been talking about 500 shares, right? So we'll have 500 shares, and that means we're going to have how many short calls? 5. The long stock is considered a bullish position, right? You buy stock with the hopes it goes up. The short call is actually considered a bearish position. Interesting. Now, the combination of the two still nets out to be at least neutral to bullish. Let's just pick a stock. With the market being up at these crazy highs, if you will, the stock's at 84.70. So we'll have some fun here. The short call that we would use to apply to the stock, we're going to use something that's called near the money, which frankly, right now in today's market, with, big down move, big up move, and so far today, big down move, it's like when you start netting out the movements, we're not really going very far right now. This is actually a perfect strategy for a market like this. Your stock's at 84 bucks, sell an $85 short call. And we typically are going to sell about 1 month in time. Again, I bet you there's weekly option traders out there, and you guys know that you can outperform. But we're going to use a 1 month time frame. It's the most common, it's the most simple. And we're going to get a nice dose of premium too. We're going to take in the bid price of $1.55 a share. When we sell to open an options trade, we always sell to open at the bid. That's why we're doing 155. So if we have 500 shares of stock, and let's say it cost us $84.70 per share, we have $42,000 in capital committed. If we add 5 short call contracts, and we take in $1.55 per share, and there's 100 shares in a contract, that means we're going to get $155 per contract put in our pocket. And it's ours to keep forever. So after we get done selling those 5 contracts, we're going to put $775 of capital in our pocket. A 1 month return, that's 1.8%. If we did it 2 months in a row, we're now looking at 3.6%. If you just did this one simple step, you can get a 12-month return of 21%. Now, those folks that want to shoot for 10% a month, they're going to take on tremendous amounts of risk. 10% a month is 120% a year, and we talked about that earlier. Buffett only shoots for 10% a year. So if you do this so simple strategy, you're going to double what Buffett shoots for in a whole year. And this is considered very low risk. Why? You already own the asset. You own the home. You're just getting monthly rent from it. And little by little, it really begins to add up. And then you can even reinvest your profits, add more shares. Before you know it, you're at 600 shares and then 700 shares. And you keep making this basically pay yourself till the shares are free. So your first $1,000 in trading options is going to be made in less than 2 months. You have now turned a $40,000 asset into almost 10 grand in annual income. Let's go back and look at it again. The first month you make about $800. Second month you make about $1,500. By the end of the year, you almost have 2 grand. I'm sorry, almost have 9 grand, 10 grand in your pocket. So you do it on a 1 month basis. It may not feel like much, but holy moly, does it begin to add up by the end of the year. You've now taken your cost basis down by more than 20% in the asset. And like I just mentioned, not only is the income increasing, but the risk, it's decreasing. If you owned the stock alone, if it's not paying a dividend, you're making $84. I mean, you're not making anything. Your cost basis is the stock purchase at $84.70. You're doing nothing. It's just sitting there. But each month you do the short call, your risk keeps getting reduced further and further and further. After just 1 month of applying a very simple covered call strategy, your risk goes from $84.70 down to $83.15. Month 2, $81.60. Month 3, $80. 4 years later, you have a $40,000 asset for free. That's pretty powerful. And I can't tell you how many option traders that are sort of new to options, like I was, and they hear like, oh geez, I can only make 1 or 2% a month. That's really poor. And my reply is, I thought that too. But do you know what happens after 3, 4, and 5 years? And then you do the math and their eyeballs just explode. They're like, holy cow. That's right, you pick up all the nickels along the way. And by the end of the year, it's a pretty amazing result. And like I already alluded to, this is very similar to owning a home free and clear and renting it out each and every month for income. Remember, even if the stock price, even if the price of the stock falls, it goes from $84.70 where we bought it to $83.70 to $82.70. Over time, the risk is going to be reduced to zero just by adding short calls. And what you care about, it's not so much the price. It's the income that you're getting paid on a monthly basis. Or if you're a more savvy options trader, you're doing it with weekly options. And then if you're doing weeklies, you can far outpace this 20% return on a year-end basis. So the first example was selling a short call right at the money, what we call near the money. All right? Which I think right now in this market, we're live on the air, it's perfect. It's a great strategy. But let me take you through some other scenarios. If you think a stock is going to rise significantly, what would you do then? Okay, well, let me ask you that question. Do you think a stock is going to rise considerably? Twitter, Facebook, they've been hanging in there pretty good. So let's say this is Twitter or this is Facebook you're looking at right now. And you say, wow, the charts are still bullish. I know the market's been pulling back here today, but man, these little turkeys, they are still moving up considerably. That's cool. So instead of selling a short call right where the stock is trading, we can decide to sell to open a short call higher than where the stock is trading. So our stock's at $84.70. This time, we could go out to strike 90 per se. Maybe that's a previous resistance level, or simply, if it's in the case of Twitter and Facebook, these guys are at all-time highs, we'll just go higher than where the stock is trading. So we still have 500 shares. We're still going to initiate 5 contracts. But notice what happens to the credit this time. In the previous example, we took in $775 by using 5 short calls at the money, near the money. Because we're selling these short calls further away from where the stock is trading, our credit actually drops all the way down to $320. So now we're not reducing our cost basis as much on a month-to-month basis, but we can now actually continue to profit if the stock does go all the way up to 90. In the previous example, we initiated an $85 short call, so our profit was capped right where the stock was trading, but we were making the income. Well, not in this situation. Our income is dropped by half, But now we could potentially make another $5 if the stock continues to rise. Note, if the strike price is higher, just like I said, the potential gain is greater if the stock does indeed rise. If the stock is flat, the income is going to be smaller, as I've already indicated, because we're only taking in $300 net. And if the stock falls, and this is what's important, if that stock were to fall, the risk per share is higher because you took in less credit in total when you initiated those short calls. Now, Chuku, this is going to go to your question. What happens? I like this picture. What happens if the stock falls or the market's actually going into correction mode, right? Well, we can handle that too. If you have stocks that are in bearish trends, like Caterpillar, like EOG Resources, a lot of the oil industry stocks, oil service stocks have been in bearish trends, Apache, Schlumberger, and so forth. What do you do then? Because the company might be fundamentally sound. I mean, heck, even Apple goes through selling periods. The spiders, like it is now, goes through selling periods. What do you do if the stock does go down and you don't think the company's going to go to zero? Otherwise, you wouldn't own it, right? Well, we can actually get even more creative. What we can do is actually short a call, apply a short call, sell to open a short call, lower than where the stock is trading. Now, initially, that might sound very counterintuitive, but it's actually pretty sneaky. If we initiate a short call at 82.50, it's considered in the money. Now we're going to take in $3.05 a share. Wow. Big difference, right? Before we were getting $1.55 and then less. Now we're getting $3.05. So what happens in this trade? Now remember, that $3.05 you take in per share, $305 a contract, that's yours to keep forever. All right, well, let's do some analysis. The stock drops, but yet we profit? Exactly. The stock was at 84.70. The strike price that we sold was 82.50, lower than where the stock is trading, but we took in $3.05 a share. Let's say the stock goes from 84.70 down to 82. You have lost $2.70 on the stock, right? But the option actually had a $3.05 gain. So even with the stock dropping $2.70, you still made 35 cents a share, which is going to be enough to probably cover your commissions and then some. So the risk of holding a stock alone is definitely greater than if you had covered calls. Now, what we like to teach at Market Tamer, which is something that's going on right now in the market, is with the market getting choppy, appears it might be at a short-term top here, and we don't know how long that's going to last. And also keep in mind we're coming into a very bullish time of the year. When there's uncertainty abound, which I think is fair to say, right? You have the Middle East, you have Ukraine and Russia, you now have Ebola, you have the Fed, you have Europe. It's like negative interest rates. There's a lot of bizarre things going on. So when uncertainty is high, you can add short calls right at the money where your stock is trading. Because when you take in these credits, it does immediately reduce your cost basis, your risk on your stock. And if you're concerned, the stock actually might drop a little further, like stocks like CAT or EOG that are definitely in bearish trends right now, go in the money. Sure, the credit that you take in is going to only moderately reduce your cost basis. It is generating income. But if the stocks really get bearish, and something I'm going to show you in a little while, we could go out and add long puts. So what I like to call these short calls is their mini insurance policies, just for the near term. Because I would rather sell time on an option than buy it. If you buy an option and the stock does not move in the immediate direction, that you want it to, you're losing money. That's what the professional option traders know. However, we're selling. We're basically the professional options trader now. We're the ones that are selling the premium. So adding short calls, even though the market quote is not aggressively bearish right now, is a great way to put money in your pocket while the market sorts out what the heck it wants to do. So one more time, the risk in this, what we call in the money short call, it drops our share risk down to 81.65. Even though it was at 84.70, our cost base is 81.65. If the stock went nowhere, it actually finished right at 84.70, we could still make money. How? Even though we would sell the stock at 82.50, which is the short call strike price. Worst case, we get to expiration day on the option. When you sell to open a short call, you're having an obligation. That obligation is to sell the stock at a fixed price within a set time frame. So you must sell at 82.50 upon expiration. But wait a minute, you bought the stock at 84.70. I know, you bought at 84.70, but you took in 305 credit. That's yours to keep forever. So actually, even if the stock went nowhere, you can still make money here to the tune of 85 cents a share. So you're right, if the stock ended up going sideways, you're still okay. 85 cents is better than being down over $2, right? So you're basically building in a cushion room when you add short calls. So even if the stocks do go against you a little bit, you have some protection. Now, like we're going to talk about here shortly, when stocks get aggressively bearish, we're going to try to capitalize on that too. So you definitely need to rethink what's possible. Most option traders think they need to buy insurance or protection as the stock drops. I mean, after all, you do pay for insurance on your home, right? On your car. But in the stock market, you can actually use options to get paid to protect your stock initially. If the stock stays flat, we can make money. If we sell a short call right at where the stock is trading or a little below where the stock is trading to be more hedged. If the stock rises, we can still make money. And if we initiate short calls higher than where the stock is trading, we can make even more money. And like I showed you, believe it or not, even if the stock falls a couple dollars, we can still make a little bit of money. Now you're probably asking, what if a stock falls off a cliff? Well, that's what we're going to talk about now, but I do want to address one point, and that's stocks that pay dividends. I don't want to get too granular here, so I don't take everybody off track, but if stocks pay dividends, they're handled a little differently. And if you do own the stock and a dividend is paid, you're still okay. But typically you can actually look to adjust those short calls before you go dividend, before it goes to dividend. So can you use weeklies on dividend paying stocks? You sure can. This strategy does work on dividend paying stocks. We just have to be a little proactive and adjust the strategy slightly. That's all. But yeah, we can actually use this on dividend paying stocks, believe it or not. So that brings us to the good old Murph. Whatever can go wrong will go wrong. I don't know about you guys, but even though I consider myself to be a pretty good trader, I'm sure some of you guys do as well, you are going to buy a stock and you will literally buy the top. You almost ask yourself, how can I always keep doing this? How can I always be the person that buys the top? Happens to me too. But we're going to be able to fix that. If the market does go bearish, or your stock goes bearish, and you did buy the top, or maybe you bought at a really great time, but then the stock rolls over. Okay, if we get those quote sell signals that we're going to talk about, and boy oh boy, we are going to keep it simple. We can add other options to the stock trade to protect ourselves. And I want to ask you guys to imagine yourself in the trade too, and it's going to be fun. Because as important and as fun as it is making your first $1,000, protecting your nest egg, it's absolutely vital that you do not let your $10,000, $100,000, $1 million portfolio get whacked in a downtrend. And what we're going to show you is there's a way to protect your stock, still generate income, and sleep like a baby every night. So let's have some fun. Take a look at this stock. I am not going to give you the stock's name. No way, Jose. Takes all the fun out of it. Imagine you just purchased a stock inside that white arrow. Now, if you're wondering, and we're going to get to this, these are some moving averages, but if you just look at the bottom right-hand part of the chart, the stock's been making higher highs, right? Higher lows. In fact, I know on the left side of the chart it was way up there. It came down, had a little corrective move, but now it seems like it's bouncing higher. So we assume that, you know what, it does look like a good time to enter the trade. So we're going to go out and buy that stock at $72 a share. Now the blue line is the 5-day EMA. The red line is the 20-day EMA. Again, if you like an 8 and a 20 or an 8 and a 21, knock yourself out. It's sort of like inviting the family over for a chili cook-off. Everybody's going to make chili. It's all going to be good, but everybody has their own recipe. We like the 5 and the 20. They're the most common. And if most folks are using it, I want to use it. It actually plays into our favor. So we're going to go with a 5 and a 20 EMA. The blue crosses down through the red within that white circle. We consider that to be a very simple and easy to follow sell signal. So while we bought the stock at $72, which was literally the high tick, it was hilarious, or almost the high tick, the stock went down 4 straight days after we bought it. Crazy, huh? We got a sell signal. We now become methodical. We buy a long put. And what we do is we typically go out about 3 months or so. We buy the long put. We're going to buy that long put option at strike 70, and we're going to pay about $5 a share. So if the stock was purchased at 72 bucks, and we add a strike 70 long put and pay $5 a share, even if the stock went to zero during the time we own this long put, the most we could lose is $7, period. How do we get that? Take the price you paid for the stock, add in the insurance policy of the long put, which is $5. That means your cost basis, stock plus long put, is $77. And as an owner of a long put option, you have the right to sell your stock at a fixed price within the expiration cycle. So if we go out 3 months, even if this little sucker went to $10, $5, $0, you get to make some poor person buy it from you at 70. That's why your risk is only 7. Dramatically different than just owning stock and hoping and not sleeping at night, right? Oh, and one final point at the very bottom of the screen. Just like we do short calls, typically on one short call for every 100 shares, we're going to buy one long put for every 100 shares of stock. So if this is a 500 share purchase, we would buy 5 long puts. Now check out this chart. The bottom right circle is where the stock is now. So it went all the way from 72 down to 58, 60-ish. So I have a question for you, and you can have some fun. Go ahead and commit to an answer. There is no wrong answer. I'm serious. There isn't. If you bought the stock at 72 and then bought the puts when the stock was at 68, and you saw that stock go from 68 down to 58, would you sell to close the long put? Would you close the long put and capture all those profits from the long put option? So I'm just going to pause here, let you guys try to answer a little bit and have some fun with this. Please do commit, especially when there's no wrong answer. So it doesn't matter if anybody else sees your answer. It's the right answer. Because let's face it, option traders, how many of us have bought a long put option, watched the stock go down, and you have all these profits and you're feeling so great about yourself, only to see a day or two later the stock rips your face off and goes up and all the long put profit is gone? I bet you every single one of us can raise our hand. All right. The other thing you might be looking at on this chart is look at the left side, that left circle. There is a previous support level. Stocks bounce at support. That's true. All right? Here's your answers. One of your answer. If you decided to bank profits from the long put position, meaning you closed your long put because it had so much profit, you just found out that you are more aggressive by nature. Nothing wrong with that. If you decided to hold the long puts, you just discovered you are more conservative by nature. Now, keep in mind, even though the stock went down and tested a previous support level in the $58 area, the blue never crossed up through the red. You never got a buy signal. You're still on a sell signal. Now, if you're trying to figure out which one you are as this, there's basically two simple schools of thought. If you decide to sell the long puts, you're one of two types of people. You're either younger, far away from retirement, or B, you have a small amount of capital committed to the trade. So you really don't care if the stock drops a couple more bucks, bounces, doesn't matter. You just want to take some profit. If you decided to hold the long puts, what this usually means, you're closer to retirement. You can't gamble with the nest egg. You must protect the stock at all costs. Or B, it's a larger size of your portfolio. So whether you're 34 or 64, if it's a big piece of your portfolio, you still have to protect it. And that generally pretty much puts everybody on, you're either on this side or you're that side. So both answers are right. It's just what kind of trader are you? Well, what happened? Conservative traders were vindicated. The stock collapsed from 58 all the way down to 50. Holy moly. We never got the buy signal. So the stock's down another $10 since the previous point on the chart. So now these long puts are really, really profitable. With earnings imminent and the stock now all the way down at 50, we don't want to hold these strike 70 long puts in case it pops up and then it wipes out all the profits, right? We've been there, done that, got the t-shirt. But at the same time, we don't want to go through the big E, earnings, and have no long puts, because what if there's a reason that stock went from 72 to 50? What if they all know something we don't? Happens all the time. And the stock goes from 50 to 20. Holy cow, that would be awful. So now we have a dilemma, right? Here's what we do. We sell to close the strike 70 puts, bank some serious profit in those options, but at the same time, we buy to open a new set of long puts down at strike 50. This is called rolling. It's a fancy term. You close one, you open another at the same time. That way you're never left unprotected. So we originally paid $5 for these long puts up at strike 70. With the stock at 50, these long puts are now worth 20. We have 15 bucks in profit. Now I get it. The stock went from 72 to 50. We didn't make dollar for dollar, but we did make $15. And that's pretty cool. So the final math on this is, on the long puts so far, we paid 72 for the stock, we made $15 in the long puts, but then we had to buy new long puts for $3. So our new adjusted cost basis is 60 with the stock at 50. So we're still $10 underwater. I get it. But doesn't $60 beat the pants off of having a cost basis at 72? I would think so. I definitely would think so. And there's a lot of other cool things we can do to make that cost basis even lower, but we're keeping it simple. I only have an hour of your time. Look what happened to the stock. It rips up. If we would not have closed that long put option down there, we would have given back a ton of our profit. That's why you do it. Hey folks, I don't care if the stock is Apple, Kimberly-Clark, General Mills, Walmart, you name it. All stocks go through selling periods. The big money's moving from one spot to the next to the next. It's even referred to as seasonals. And it keeps going. Not all stocks are going to go lower left to upper right the entire time you own them. So when you have these companies that you own, which I hope you own them because you actually believe they can grow over time, that's the whole point in owning them, that even when they go through selling periods, we can use options to drastically reduce our cost basis. So now the stock pops back up because guess what? For whatever reason, there was a sell-off, but the stock's back in action. Now look what happens. Now the stock's back at $72. Holy cow. Folks, if you just did a buy and hold, what happened? You bought at the left top circle, and now you can sell at the right top circle. How many people would say, I held the stock, I bought it at 72, it went down to 50, and now it's back at 72, and you're just going to sell? You're like, thank goodness I just got my money back, right? How many of you would have bought at 72, rode the stock down to 50, and said, man, I just have the worst luck ever. I think I'm just going to close this trade because maybe everybody else knows something I don't. The stock just lost like a third of its value. It could get much worse. I'm just going to sell, only to watch the stock go right back up, right? It's happened to all of us if you trade. And here's the other thing. You were probably freaking out while the stock went from 72 to 50. So buy and hold, a ton more stress. You weren't sleeping. You're probably cursing yourself and spending countless hours on the weekend wondering what you did wrong again. Listen, you can do all the fundamental homework in the world. Sometimes stocks just trend down on great companies. But if they want to do it, let them, and let's see if we can't make some money or at least sleep well at night. By using the protective put adjustment process, all a protective put is long stock, long put. It's also referred to as a married put. You made $12 a share. You made $6,000 on 500 shares. You had a lower cost basis of $60. And you slept like a baby because your risk was always defined. You were actually becoming a cheerleader. If you have a fundamentally sound stock and it's going down, you're actually a happy camper. Stocks fall a lot harder than they do rise. It's much more quick. You can actually have a better chance to make more money if your awesome stock drops, because it takes a long time to go back up. So the keys to the trade were following the rules, very simple rules, and we weren't panicking on downtrends. And we recognized that gains are not made overnight, but that we can actually make pretty gosh darn good gains over time. Look what happened to the stock. Now it's up at 92. Holy mackerel. So we bought at 72, the high of the day, literally. Comes all the way down to 50. We ride it back up to 92. Now we're talking a 50% return in 7 months using sleepy style options, and we weren't even using weeklies. We weren't being proactive. We didn't double down on puts. We didn't add bear calls. We didn't do all that extra awesome stuff. We just used a very simple crossover system. So here's the recap. If you own stocks, you want to sell calls near the money for maximum premium to generate monthly cash flow. There's your first 1,000. And in that example, we didn't even talk about using short calls, right? No, we didn't. So if you're concerned about a slight correction, maybe right now in the market, with the S&P's whacked, well, hey, about selling some calls right at the money or right near the money. I mean, at least take in some premium, right? And if the stock really starts to correct and we do get these sell signals, guess what? We could use a 5 and a 20 crossover system. So now you know how to make your first 1,000 and beyond. You know how to protect your portfolio even when stocks fall, and have the potential to make way more than your first 1,000, even if the stock goes against you. Now, folks, I'm trying to watch my time, and I want to respect your time, so we're going to do Q&A here in just a moment, but I want to give you guys a great opportunity. It's the best price we've ever offered. When John invited us in, he asked that we come to you guys with, frankly, the best deal we got, and that's exactly what we're going to do. Everything that we showed you today, how to use the short call, we can show you how to hedge your risk. We're going to give you all this in only a $7 package. I'm not kidding. And you're going to get live coaching. So here's what we're going to do. For this special live coaching program, you're going to know how to hedge risk and increase profit potential. We'll talk about what strategies we're using right now. We're going to talk about how to fix broken trades when they go against you. How to sleep at night no matter what the market is doing. Remember when we have those long puts in place? We're on a sell signal right now in the S&P, for example. You could use this system. You're sleeping like a baby. It's like, oh my gosh, We're down huge. Oh, we're up. Oh, crap. Now we're down again. You're sleeping like a baby. You just don't care. You can use short calls and long puts to protect yourself. Folks, you should be able to post gains in any market. You should be able to adjust losers into winners and trade options for weekly income too. So we can show you all this. It's our best offer ever. It's markettamer.com, TR/offer. Now here's something else that we're going to offer you guys, because there's a lot of, I'm really good with names, but there's a lot of folks here that I also see that are brand new. So we wanted to give you sort of the our best test, sort of to feel us out, to get to know us better. We're also going to give you guys bonus access to the Market Timer Algorithm Select. So yes, we can show you guys how to hedge your risk. We can show you how to generate income, but we can also provide trades for you. One pick every Monday generated by our algorithm. You're going to get access to a weekly Market Timer Algorithm Select coaching call every Monday at 7 p.m. Eastern with me. We're going to talk about the algorithm trades that are open, how we can manage them, how we can lock in profits and limit losses. And I actually want to show you what the algorithm, looks like. You're going to find companies that are well known. We can teach you how to manage these trades. We can show you how to exit. In fact, after you get one session with me, frankly, you don't even need to see me every week, because you're going to know how to manage the trade yourself. We make it very, very simple. So I'm going to show you some trades from March right up until now. The algorithm selects LinkedIn as a bearish pick. Again, this is yours complimentary with the $7 trial. Hours later, actually, it's a nice big profit, 97%. Bed Bath & Beyond, bearish. You hold the trade. You notice the blue line? That's the 5-day EMA. We make life really, really simple. So we can show you how to do these types of trades. I can show you the exits, and then you're on autopilot. This was actually a long trade. 16 days is a very long time for the algorithm. Here's Autodesk, May 27th to June 6th. This was actually 83%, 11 days. This is all what you're getting access to. How about MasterCard, a one-day trade, 21%. Harley Davidson at the end of July, a one-day trade, 31%. 11 days, 140%. Here's Procter & Gamble. Huge move, right? Couple day trade, over 100%. Here's CAT, which, by the way, I didn't want to update the slide because I still had it, but with CAT being so bearish, and frankly, with the S&P getting whacked, CAT's probably even down further. Yeah, it's back at the lows. This is way up over 100% now. And this is back from September 22nd. This would be a very long-term trade too. So what we like to do in the algorithm is, for those folks that know options and they want to keep running with it, we like to take 20% immediately on a part of the trade and then let the rest of the trade be open and use a 5-day EMA as a trailing stop. So within 2 days you had your 20%, and now it's more than paid for. And what was interesting here is this is a pick just from this week, which is NiSource. This pick actually had a 20%, almost a 20% gain already, even when the market is down. Now, right now, NI is actually below its 5-day EMA. This one might get stopped out. So why did I even show it? Well, think about this. The market got hammered already. NiSource was at the cusp of 20%, even with the market getting hammered. Only today is it finally getting back below the 5-day where it might get stopped out. So regardless if the market is bullish or bearish, regardless if you want to do directional trading or credit spreads, we're going to be able to teach you some education. We're going to give you access to the algorithm so you guys can learn and earn all at the same time. So let's go over the coaching calls one more time. Every Monday, you're going to get a 7 p.m. Eastern coaching call with me on the Market Timer algorithm. We're going to talk about what strategies to use on the pick. We're going to talk about what stops to use, what targets to use. So you're going to get all of that information covered actually by me, the guy who's talking to you right now. And then an hour after that one ends, we do an encore. And we do the market outlook, and we're going to give you this as a complimentary bonus. This is where we talk about what the market is doing for the week ahead. That's why it's called the market outlook. We talk about support, what resistance levels to watch for, and actually what we do for for the members, our members last night got a bonus whereby I actually said on the cues, watch the 20-day EMA. The NASDAQ just keeps getting clipped by it. It just can't seem to get over the 20-day EMA. Once again today, that's exactly where it got stopped in its tracks. So we're actually not going to be bullish on the cues here short term until we get back above the 20-day. We sort of got teeny weeny bit above it yesterday, but I said, it's not enough. What we need to do is we need to get to about $99 on the cues. And the same thing with the spiders. It's like, listen, the spiders, they need to get above the 20-day. They didn't. They literally tagged it today and they rolled over. It's just uncanny how that stuff works. So we cover that. I also take your individual stock questions. What we do is we spend about 20 minutes going over the market, and the last 40 minutes are trades or stocks that you have open or you want to look at, and we talk about them together as a group. You have members there helping you, typing in questions for yourself. So it's really a nice community of traders, and we help each other. But you also have me. It's sort of like bringing your trade or your stock, to the doctor for an exam, so to speak. And we cover that and much more. So another bonus that you guys are going to get access to is the vacation trade. So you're going to discover that we call it the slow summer months, but let's face it, folks take vacations all the time. If you're going away at the holidays, whatever holiday you're doing, you should be able to place trades that have the potential to at least eliminate risk or close to eliminate risk, but also be able to potentially give you a return while you're on vacation. I got to tell you guys something. I started researching the market back in 2000. I've been doing this, almost now 15 years. And the worst feeling in the world is, you sort of leave for vacation and you see a trade and you're up thousands and thousands of dollars. And this actually happened to me one time. And you're basically on a plane trip to Hawaii and you're sitting there thinking, wow, that just paid for my entire vacation. I didn't do any work. And then you get to Hawaii, you start having the Mai Tais on the beach. You're looking out at Diamond Head and you check the computer 2 days later because you lost track of time because you're having such a great time, and all of a sudden the trade's down $3,000, $4,000, $5,000, and then you say, wow, how did I go from paying for my vacation to just losing a vacation? And the fact of the matter is, when you go on vacation, man, the last thing you want to be doing is watching your stocks. So we can actually show you vacation style trades that you don't have to be freaking out when you're away. If you're going to keep the trade open, cool. You can protect yourself because enjoy your vacation. You earned it. You shouldn't be freaking out about it, right? So everything we have listed here is what is covered. Again, you should be able to profit no matter what your stock does. Gang, this is going to be a 14-day trial for just $7. So it's about $3.50 a week. You're going to get a total of 4 coaching calls. You're going to get access to 2 algorithm select picks, 2 Mondays, the Monday coming up and the following one, and we're going to give you access to the vacation trade training. You're going to get all this for only $7. Now here's the thing, because there's 2 live classes in here, both are going to be with me. I can't take 200 new people. It would be nice to have 200 people buying a $7 trial. That would be very flattering, and knowing that everything I did with you guys resonated and you found it interesting and you wanted to try it. But that would be utter chaos because you'd be in there with our current members and then it just, it's not good for everybody. So what we're going to do is we're going to do 50 traders at the $7, and you just go to markettamer.com/TR-offer. And when the 50th one gets purchased, the slide will actually go to sold out. So you need to do it now because I don't have a counter. So I'm not going to be able to know precisely how fast these are going to be selling. The other thing is customer service is actually important to us. So when you guys do write in, we actually do want to respond. It is important to us. So here's the summary again. You're going to get 2 stock selections during your trial, 4 coaching calls over the 2 weeks, 2 each week, and you're going to get bonus access to the vacation trade, all for $7. So gang, go ahead and type in your questions. John is helping me here, and he's going to type some in for me to make sure I don't miss them. So let me just hit off a couple of them. So Chuku, I actually saw your question come in while I was doing the presentation, and you had asked about, hey, what do you do if the stock actually rolls over and trends down? I covered that for you. We're okay with that. I mean, hey, if the market wants to go lower here, at the money covered calls can be great. And let's face it, with earnings season upon us, you guys should already, if you trade the way we trade at Market Tamer, you already have long put options against your stocks if they report in the next week or two. So while the stock's dropping, your puts are actually increasing in value. And with the VIX spiking, the volatility is helping your put options too right now. So our members, they're already protected. So we don't care what the stock market does. I mean, me personally, I'd rather it just go up because it's not going to hurt as many people. But if it goes down, we're fine with it. All right, Dag, how you doing? So that was Chugu. We got Dag. What are your thoughts about a contrarian approach, such as a covered call on oversold stocks? Okay, very interesting. If stocks are oversold, I would not necessarily want to short a call. What I would want to do, Dag, is I'd want to go back and look at a 1 or a 2 year chart, a daily chart, and bring in like an RSI, bring in average true range, look at Bollinger Bands. I want to see what the stock has done previous times when you say it's this oversold. Because you can actually, history does repeat itself. And if the stock is looking grossly oversold, frankly, if you're willing, I prefer not to sell a call right away and see if you can catch a big spike back up and then short the call and take in even more premium. But if you really want to be in lower risk mode, Dag, go out like 3 months then and short a call and go a little further away from the money to take in some premium. And if stocks are in downtrends, Dag, covered calls work fantastic. Caterpillar, Apache, EOG, you name it. These oil service stocks that have been getting whacked, weekly covered calls, monthly covered calls are working just fine right now. TNT, are there certain types of stocks that offer weeklies that work best? We actually have a weekly live trading room. It's a different program. But in there, we like to trade Win, Tesla, Apple, CF, CMG, Google, and even the SPX. Sunil, but what if the 5 and this is a good question, yeah. What if the 5 and the 20 EMA crossovers start whipsawing? Wouldn't the long put begin to be, and I'm sort of paraphrasing, be counterproductive? Sunil, the answer is yes. And here's something that's important. There is no crossover system. There's no system of anything out there that's going to be perfect 100% of the time. I don't think there ever will be. Of course, unless you're the Fed or Goldman. But, for everybody else, no, there's no perfect system. So what I like to do, Sunil, is find stocks that actually have symmetry. I want to trade companies that actually trend. Because if you have a stock that looks like a Mexican jumping bean, or a 5-year-old gone bad on sidewalk chalk, how can you do anything? How can you ever predict what that stock may or may not do, right? It would be impossible. So if I have a stock that completely ignores the 5 and the 20 EMA crossover, and it's always just jumping up, down, you're right. The long puts would get destroyed. I don't want to trade that stock. I wouldn't want to trade that stock even if it was one of the most fundamentally sound stocks out there in the world. Because every time I try to protect myself, I get killed. And then finally, when you do need it, you may not have it. So, one of the things I like to teach folks is, and we do that actually at Monday at 9 p.m., is you want to trade stocks that have that symmetry. It's so important. So that's a good question. And by the way, every question you guys are asking is good. They're all good questions. There's no dumb questions at all. Because if you have that question, I guarantee you somebody else here does too. So I thank you for asking it. So please do ask your questions. I will answer every one. Let's see here. T. I hope I'm getting the right person with the right question. their name right. T. How long have I been doing this again? T, I started learning about options in 2000. And just to give you a little background on myself, right now I'm 41. I just turned 41 in September. And how I got into the stock market is actually really bizarre. My father and I both worked in retail. Our whole family did. And we didn't have any 401ks or IRAs. It was only money you saved. And you know the story, right? I'm so poor type of thing. And we were. We were really poor, lived in the country. So none of us have any IRAs. None of us went to college. And I was sitting there with my dad, and he had some money in a brokerage account. And it went from 10,000, which was all the money to him in the world. And it still is a lot of money. But, he had $10,000, put it in, and then it became 5,000. And then it became like 3,000, right? You know the story. The term broker, they make you broke. So I was sitting there listening, and, the full service broker at the time said, hey, buy these stocks. And we knew it was high risk, right? That trading is risky. So when it went from 10 to 8 to 5, that's just trading. But okay, you got the bad ones out of the way. Hopefully the good ones are now going to make up for it, right? That's the whole point. Well, when we got to 3,000, I'll never forget this. My dad answered the phone, or he called the guy. Guy answered the phone, and he says, hey, I'm down to 3,000. I understand stock market is risky, but I really didn't think I'd be down this much so far, but I'm not scared. I want to make money. Would you give me another stock to buy? The broker said, unless you have $5,000, I'm not going to talk to you. And he hung up on my dad. And I'm sitting there listening because he was on speakerphone. I was floored. So my dad took this guy's picks. They went from 10 to 8 to 7 to 6 to 5 to 3. And then he had the audacity to hang up on my father after all of his picks lost money. My dad's down to his last $3,000. And had I not been eating lunch with my father that day, listening to how demeaning the broker talked to my father, I probably never would have researched the stock market. So it's a really crazy story. It was just one of those things where I got so angry. I was like, nobody's going to talk to my dad that way. And I just started researching the market. And then what I found out was, when I began to read it, I'm like, I consider myself, pretty sharp, but I may not be the sharpest cookie in the oven. And when I started looking to do options trading, it was always so bizarre. Like, why is everybody making it so hard? They're talking about insurance, and then they're talking about the Greeks, and, I like Greek food, but I don't need to know what, trade Greeks, to make money in the market. So yada, yada, yada. And then before you know it, here is Market Tamer, and now we help, the average person understand options, which I think is really important, because you need to understand how to hedge your risk. Without it, when this market eventually does roll over, it's going to be horrific. We're going right back to 08 and 09, where it's just going to be bloodshed. Not yet, but eventually. So there's no better time than now to start learning. So T, thanks for that. Oh, T, you have another question? If I don't yet own stocks, would this really be beneficial to me? I think so. Now, if you say you never plan on buying stocks, I would say, well, I guess you could still learn, but what's the point? So the whole point of this is, if you have stock or plan on buying stock, we can show you how to protect yourself. Make money in up markets, chop markets like we're in the last couple days, and even down markets. If you are strictly, purely an options trader and you do not want to own stock, in today's offer that you guys are actually going to get access to the algorithm for 14 days too, and then you can have that as a quarterly membership. T, I think it's worth it just for the select alone. Absolutely. Okay, you guys can also click the link in the admin box if you would like to try up. Ian is telling me that we're already over halfway through the trials, so this is really, really awesome. Good stuff. That's all. Thank you guys so much. That's very kind. It's great. I look forward to having you guys in the live class. Your live classes are going to be Monday at 7 p.m. and 9 p.m. And don't worry if you can't attend live. I bet you there's some folks listening in from Europe and Asia right now, but this might, 7 o'clock and 9 o'clock on the East Coast, you guys might be in bed or at work. If you're in California, you're going to be at work, or maybe sitting home, sitting at the dinner table. I record these sessions and I post them to the website that same night, so you have access to them, right away. And also, don't forget, you're gonna, we really do a bad job at telling you guys all the bonuses, but here's 2 more bonuses you're going to get. On the weekend, on a Sunday, I record a short video on the market and actually email it to you before Monday even happens. And I record a video on the market timer select pick that actually highlights what strike price to use, how much to pay or sell if it's a credit spread. So I do all that for you. It's really cool. So you're going to get 1 pick every Monday, 2 live coaching calls each week, the vacation trade video, and you're also going to get 2 videos on the weekend that's not even on your screen. So you're going to get all that for the $7 trial. Oh, Cornelia? Cornelia is asking how much the quarterly rate is on a rebill. Yes, I would be happy. I'm going to do. If you actually type in the link, you go to markettamer.com/tr-offer. If you guys go to the buy page right now, and if you scroll all the way down, where it says enjoy your service, right above there, this is going to rebill at $3.98 per quarter. That's it. So we don't do monthly, we don't do 6 months, we don't do yearly. You guys can actually get it locked in for life at $3.98 a quarter. So you can just go quarter by quarter by quarter. If you want to try the trial out, I think it's an amazing deal for 14 days. To cancel, we make life really easy. Just send us an email at cs@markettamer.com. CS stands for customer service at markettamer.com. We cancel it for you. No problem. If not, we simply conveniently bill your credit card and you're good. So we make life really, really easy. Thanks for that question, Cornelia. Thomas, are all your recommendations covered calls? Thomas, they are not. What we wanted to show you guys is, even if you don't even try us out, I wanted you guys to take something away from the presentation today for free. And that's why we talk about the covered call approach, where you guys, I can just show you right then and there today how you can short covered calls. The algorithm is stock or option based. So if you guys like having trades provided to you, there you go. We can review them every Monday. You don't need me to follow the trades with you, because once I give you the exits, you're on autopilot. It's that simple. So Thomas, the covered call example, how to make your first $1,000, that's just complimentary. I just wanted to show you guys how to do it. But if you want to learn how to do it even more, we can talk about that in the Monday night session as well. All right. Okay, there's another question, but there's no name attached. And the question is, if you have a loss in a good dividend stock, what would you do? No name, would you be willing to give me that stock? I could maybe look at it on the fly here for you. So if you can do that in all caps or something, and then John or I will see it, I'll be happy to give you a specific comment on it, because I am able to do that while we're live here. But just in general, if you have a stock that's underwater and it's a good dividend stock, if there's options on it, I would look to start selling 1 or 2 month calls on it. We need to determine the current trend of that stock. If the trend is down, we can use monthlies. If the trend is up and there's no premium in the first month, we'll go 2 months out. If there is premium, we just want to be a little further away from the stock. So I know there's going to be a delay by the time you type in your answer, but let me know what that dividend stock is that you have a loss in. Just give me the stock symbol, and I'll bring it up on my other screen here, and I'll be happy to take a look at it for you. Yep, no problem. All right, a common question that I also get asked, if I can just interject this one, what happens after the 14-day trial? Do you lose any of these bonuses? The answer is, of course not. No way. You get everything you see on your screen. So for $7, the fact that you guys are going to get 4 one-hour coaching calls with me, 2 stock picks, a bonus vacation trade training, and then a total of 4 weekend videos, my goodness, it actually comes out to be like less than $1 per bonus per item. So it is a super deal. And it is our best offer we ever make. So this $7, just go to markettamer.com/TR-offer. And then you can jump on. So Ian is telling me we're now down to under a dozen. So you guys are awesome. This is good stuff. We're going to be, I think, probably sold out here shortly. I think when I told you guys to go to the buy page, y'all must have jumped on board. Really good stuff. So I appreciate John inviting us in. Let me see if there's any other questions. This is looking good. All right. Click on John. Oh, another question is, if you guys have questions, as you're attending the classes or you're watching the algorithm or watching the vacation trade, can you guys actually email us for help? If you had a question, the answer is yes. Again, the email address is cs@markettamer.com, and you do get access to email us questions too. For sure. We want you to be happy. We want you to, learn why you're here. We're going to give you access to coaching calls live with me on Mondays. All right. Well, fantastic. John, I think we might have caught up with these questions. They were all excellent.
I think so, Ron. That's pretty much the end of it. The good dividend stock question person may have jumped out to join you, so may not have heard you asking the question or answering the question, so to speak. So we didn't get the stock symbol from him, but still a valiant effort. And folks, again, last chance to claim the last 12 seats there on the $7 trial. Again, you have the link is right there in the admin notice box. You can also click the yellow button under the pop-in box, which will take you right out to that offer page so that you can get yourselves registered and claim the last final seats on the $7 trial. Again, remember that you're getting first-hand education from a decades long educator, if you will, and a real trader. And that's a big difference, because in the markets today, in the financial markets, if you will, there are too many experts out there, well, self-proclaimed experts, who aren't actually real traders. They're theorists. They're not actual guys who actually have their money in the game. And that's not Ron. Ron is both a trader and an educator, and the ability for you to learn firsthand from someone who's doing it himself is very important. So the lessons that he shared with you today, I think, have been some of the best that I've enjoyed listening to in a number of years doing webinars with other guests and guest hosts. So Ron, I really want to appreciate you, or say that I appreciate you taking all the time to share with us not only the presentation and the strategy, and folks, sell those covered calls all day long. But take what you've learned from Ron today and put it to use. If you don't do the trial, look for us again to host them in the near future, because these are the types of presentations, Ron, that we really do enjoy having online. Such high quality and really great insight into trading options.
Hey, thanks so much, John. I really appreciate being here. Your guys are very kind. They had great questions. This is one of my favorite presentations because, it gives a nice little basis, and then also, shows you how to lower your risk. And to me, that's so important, because, we're not the Fed. We can't call up HP, order more ink, and print those $100 bills. we have to protect that nest egg we worked so hard for. So it's a lot of fun for me. So thanks again, and really appreciate being here.
Two last-second questions here. Just a quick check. I'm not sure on this one. Thomas asks, by the way, Thomas said thank you for answering his question. And then he asked another, is there a session that starts tonight, or when do the sessions start?
Oh, sure. And you're most welcome, Thomas. The sessions are going to be Monday at 7 p.m. and 9 p.m. Eastern, New York City time. And then if you're not there live, don't worry. I'm going to record them, post them to the website within typically 15 minutes of them being over. So any folks that want to watch them later in the evening or first thing in the morning, they'll be all archived and ready to go. And the last question I have here is from Ant. Is it only for U.S.
traders, U.S. citizens?
Oh, very interesting question. That's a good one. As long you can be in another country outside the USA per se. You could be in Europe, you could be in Australia, but you need access to a US brokerage account. You know, I know different brokers are in different places. Um, if you know, the US stock market is the most liquid. So that's where you're going to get your best bid-ask spreads, get easy in, easy out type of things. So you want to have access to the US market to do what I showed you today.
Great. All right, Ron, I think that will be a wrap-up. Those were our last couple of questions there. And again, folks, you can click on the link in the admin notice box. I'll also put it back up here in just a second in the chat box one last time, or it's also in the pop-in box. We pretty much put the, short of having the Goodyear blimp fly over your house, we've put this link everywhere you can possibly get to it. And I'm not going to rule the Goodyear blimp out just yet, but I want to make sure the last 10 people get in there as we start to close down here. And again, $7 for the 14-day trial. It includes everything Ron has shared with you: Market Timer Select, the 2 live coaching calls, the bonus vacation trade training, plus the additional access to Ron as he's described to you here. So 2 very good weeks to have hands-on learning and profit experience potential for those of you who are willing to take that shot. Even if you're an experienced options trader, it never hurts to have another tool in the toolbox. So for $7, it's a brilliant way to expose yourself to his training and his coaching and his process and the Market Timer Select from Market Tamer. Way to funnel that one up. Awesome. All right. So last call here, and it looks like we are all good with questions. So, folks, I'll leave this page up for about 2 minutes as Ron says his goodbye, and then we will shut the call down. Again, you'll get an email in the next hour or so with a link to the replay, and you'll be able to access the $7 trial until it's gone, basically. Is that right, Ron?
Yes, that's correct. Ian's saying we're down to 7 now, so the page will stay up, and when it hits sold out, then it just says sold out. So, yep. Thank you so much.
Well, Ron, thanks again for your time, and you're welcome to get yourself back into the markets and make some money for the day. And everyone else, I want to thank you for taking time to join us today. Sorry that we ran a little bit long there, and for those of the folks like Dave who hung in there through the technical difficulty at the start there, I want to thank you for your time, sir. Everyone else, have a great day. Profitable trading ahead for Traders Reserve. This is John Hutchinson, and we will see you again soon.